So we have a record. Okay, so chapter 16 is on finance and financial management. Um, it's a very important field to understand that businesses have to manage their financial resources well, because if they don't, some bad things can happen. One of those bad things is bankruptcy. And so this particular figure that your book shares with you shows that when the economy isn't doing so well, um, as it was just starting to bounce back, 2010, 2011, you see that the number of bankruptcy filings for businesses was pretty high. And as the economy improved through the 2012, 2013, 2014, 2015, even 2016 was a good year in general, but again, it didn't stop bankruptcies from sort of bumping up a little bit. There is something called the American Bankruptcy Institute. They have a website here that keeps track of this type of stuff. If you're interested, you will probably see bankruptcies skyrocket this year, 2020, since the COVID crisis hit. The economy prior to that was doing pretty well, so the bankruptcy numbers shouldn't be that much more off than what you see in this period of time here. But probably 2020 started a new trend, probably a large increase in the number of business bankruptcies, as businesses are, many businesses, particularly small businesses, have closed. So you'll probably see an uptick this year for sure. Well, what does it all mean? Well, it comes down to, companies need to have, all companies, as people do, need to be good at financial management, right? Money coming in and money going out. Really, it's what financial management is really good at. Every single activity deals with either money coming into a company or money going out of a company. For various things, whether it's to pay bills, to buy assets, there's always things that money is used for. And these are important business decisions that are being made. And so if it's done right, what they say, proper financial management, money has to be available when it's needed. And businesses often have to plan out their year, or much longer, and to see when they are in need of cash to pay bills, or when they are in need of a lot of cash because they plan on buying another business, or they plan on building another building, or needing to update equipment or whatnot. They need to make sure the funds are there when they need it. When you borrow, getting funds, you can get funds from owners and you can get funds from lenders. What the balance sheet shows is that every time you have an asset, you're either going to get that asset because you borrowed some money, that's the liability part, or the owners put money in so you could buy it, that's the owner's equity part. So funds are usually just are received from companies either through the owners or through the lenders. And that means if you're using a lender, it's going to be a cost. The interest rate of a loan is the price of a loan. Everything, we live in a market economy, everything has a price. Loans have prices, and that's what the interest rate is. It's the price of the loan. So obviously, if you wanted to get a loan, and you saw that interest rate was 5%, and you wanted to get a loan, and another lender said the loan is going to cost you 7%. Obviously, 5% is a lower price, a lower cost than 7%, just on the face value. So businesses also have to plan and control how much money they spend. Basically, their expenses have to be controlled. And if you want to be profitable, remember that income statement we saw back in chapter 15 showed that the revenue is money coming in from selling to customers, and they subtract all those expenses out of that. At the end is a profit. So if you're not planning and controlling your expenses, you're simply letting your profit go out the door. And companies usually can't afford to do that. A company basically has to do lots of different things. Get their customers to pay on time. This is what accounts receivable is. You've sold something to a customer and you expect to receive the money. So getting that is very, very important. And of course, the company themselves have bills to pay, and they have to pay bills on time. Otherwise, they would ruin their credit and their reputation for being responsible with other people's money. Again, the firm has to pay various expenses, including taxes. And companies are actually, pardon me, corporations and companies are basically the best tax collectors the government has. Think about all the taxes companies collect. When you go to McDonald's, and even if you had something that's $1, they're going to charge you $1.08. Why? Well, because the 8 cents additional is sales tax that's going to be sent to the state government. The company is collecting that and will send that money to the state government for sales taxes. The company, of course, has a bunch of employees, and if you ever looked at your check, you'll see there's taxes taken out of your check, right? Social Security taxes, Medicare taxes. Some of you might have federal tax withholding, state tax withholding. That's money that the company has to send to the federal government or the state government, depending on what the tax is. So companies have a lot of taxes to pay. And of course, if they have a profit, they're paying tax on the profit. So there's a lot in which the company has to do. And then, of course, companies have to manage their cash well. So when you have a lot of cash, it always has to be invested. It always has to be earning interest. And so we'll talk a little bit about that as well. That's if it's done right. There's a lot of great careers in finance. I started in finance myself. I started as a financial planner. I've done fund or portfolio accounting on retirement funds. I've worked on a trading desk for debt for money market funds, which is short-term debt instruments. So I've been on many boards in terms of looking at financial issues, and so there's a lot of careers in finance. And it's I think it died a little bit when the crash happened, but it's come back to life, and I think it's still going to be growing, as everything does. So these are some typical job titles in finance, and finance is pretty broad. You can be the head of finance for a company. You can be a bank officer. You can work for consumer credit, or other type of loans. You can deal with insurance. You can deal with investments. You can analyze companies, or you can help people with their financial planning. And so there's a lot of different ways. Finance is quite big in terms of a field. And so there's lots of different options on there. It's important that you have a background in finance or accounting. They say in math, but I think it's really, it's less about, there's math involved for sure, but it's less about math and more about money. The story of where the money's coming from, where it's being used, how to explain it is really, I think, more important in finance. We have computers that do calculations for us. But we still have to talk about it and discuss financial issues, which is, I think, more appropriate today, is the communication of all that. So a background in these areas will help you a lot. Certainly we deal with a lot of data, so analyzing data is important. And like I had mentioned, it's important to be able to tell the story of what's happening to a company, or in the case of financial planning as a family or as a person, what's happening, and you can communicate that in a productive way. So communication skills are critically important, both in writing and orally. Okay. So companies need money. They need money. They might need it for the short term, which is usually defined as less than a year. They might need it in the long term. Okay. The term financing really is about getting money. How do you get money for the short term or for the long term? Well, for the short term, there's something called the cash flow problem. In other words, there might be less cash coming in this month than you have bills to pay this month. And I don't know about you, but you can't pay your bills without cash. Employees don't want a promissory note. Yeah, I'll pay you later. No, they want to get paid on payday. They want to make sure the cash is there. Your suppliers want to make sure they're getting paid, right? And you need cash to pay those bills. Well, sometimes you just don't have enough cash coming in a particular month. So what do? Well, that's a short-term financial need. You need to cover that for the short term. You might need to buy a bunch of inventory because a particular product is selling better than you expected, and you want to stock the shelves more, but you need cash for it. And you weren't planning on it. So there might be a need for that. There might be some short-term promotional needs. There might be unexpected things that might happen that you need money for. So in the short term, which is again within a year, there might be a lot of times when a company is in need of money, but needs to find it. And that's also true in the long term. So long term, we're looking at over a year. Normally periods of time, 3 to 30 years is considered that long term. Well, there might be certain costs in starting up a business. There might be costs in developing a new product. You might need to replace equipment that you've been using because the equipment you're using is sort of crapping out on you. Right? You might be interested in buying another company or merging with one that costs money. There might be expansion of facilities. You might thinking you have 20 stores now. In the next 5 years, you want to have 100 stores. Well, you're going to need money to have all those extra stores. So there's lots of plans that companies make that they need money for, and sometimes they don't have the cash. So they need to find ways in which to get the cash. That's the financing piece for either short-term needs or long-term needs. So again, the word short-term is synonymous with needing something within the year, things happening within the year. Cash flow really talks about money going in and out of a business, when cash is flowing in and when cash is flowing out. So again, cash flows in, normally speaking, when you're selling a lot of your product, you have a lot of cash coming in from customers paying you. Cash also comes in when you need a loan. That's cash coming in. But of course, you need a lot of cash going out. You got to pay bills, whether it's payroll, utilities, other types of things. You have bills to pay on a regular basis. So that cash flow doesn't always match, and so you have to balance that out. And then, of course, there might be production issues that might come up that, you might need to fix, according to the book. So businesses that are manufacturing businesses actually create and design and make products. Okay. Your book talks about Stanley Black & Decker. They make lots of different products for building and stuff and things that you might use around your home. Here they have mapped out the fact that they have this level of expenses that's the red line here, throughout the each quarter. For January, the January quarter, there should be April quarter, June, July quarter, and then at the end of the year, their expenses go down. But their revenue, the amount of money they expect cash coming in from selling their products, is below the expenses in the January period, but much higher than the expenses in the period that follows June through the end of the year. So you can assume in this particular period of time, there's going to be a lot more money coming in, cash coming in than cash going out. So they're able to use all of this cash to cover all their expenses without a problem. However, there's this period of time in which they're obviously going to be needing cash to cover all their bills, all their expenses, because the amount of revenue coming in is shorter than what they are using to expense. And so they need to cover this gap that you see here between the revenues and expenses, okay? And that's why short-term financing needs are necessary. You need to cover these gaps. You pay it back when you have the cash, you borrow it when you need, pay it back when you have it. Excuse me. In terms of long-term financing, this is usually a period of time that's much longer than a year. And so companies buy buildings, they expand, they do other types of things, and they need money for it. They need cash. There's always a comparison of the risk that you're taking in making that decision and whether it's actually going to pay off, which is the return. And so what you hear about a lot in finance is something called a risk-return ratio, because ultimately, if you're going to take a risk in borrowing money, for example, to buy something, what's the return on that? That return has to be able to cover all the costs of your borrowing and still be profitable. So there's always a risk-return ratio that's talked about. Okay, we're not going to get into it, but all companies actually have financial plans involving their needs, their financial needs to meet the goals and objectives they set. We're not going to get into that here. The book kind of goes over in more detail, but I won't do that. But I will show you, this is a cash budget for this company called Stars and Stripes Clothing. And it breaks it down into 3-month periods. Remember, a 3-month period is a quarter. And so this particular cash budget shows basically the amount of cash coming in, which is the top line here, minus the amount of cash they need going out, and the difference here. So here in the first quarter, they're $7,000 short. Right, they're going to need $7,000 cash. So this tells you they have a short-term financing need, but they have plenty of money coming in, plenty of cash coming in for the rest of the year that's going to cover this. So borrowing for the short term might be a good idea because they're going to be able to pay it back right away. So cash budgets actually kind of give a company an idea of how much. And of course, the totals are provided here in terms of cash coming in, cash going out, and the amount, in this case, the amount of extra cash they should have at the end of the year. Okay, again, this is on financial planning. Companies have budgets. We're not going to get into much of that, but I will talk about where companies get cash, because you're going to see that later on. There are 4 ways companies usually get cash. Selling their products to customers, the customers pay cash. Okay, and so that's a huge source of cash for companies. Another source of cash is to ask owners to put more money in exchange for common stock, which is shares of ownership. So money received from the owners is equity capital. Okay. Another way that cash comes in is they borrow it. Debt capital is simply borrowed money Could be from investors, could be from lenders of all sorts, banks, etc. And that provides cash into the company for its use. And of course, the company could sell assets and use the cash they get from selling assets for their cash needs. So these are important. Again, companies often rely on selling their products first as the main way that they generate cash. And then they look either, is it better to ask the owners to put more cash in, or is it better to actually borrow the money from lenders? The last thing they want to do is sell their assets. It's really not as great of a sign most of the time for companies to start selling their assets, because you usually have assets to help you make revenue, to help you sell your product. And so I'd be a little suspect in terms of what assets they're selling and why. Businesses need to use banking services, okay? And so businesses have cash. They will have a main account at the bank, savings and checking accounts, just like you and I have savings and checking accounts. So businesses will have bank accounts and keep their money there. Sometimes they have a little bit too much cash on hand that they don't really need to have all that much cash in an account. So they look for ways to earn more interest on it. One of the ways they can do that right from the bank is to is to open up what's called a certificate of deposit. Now, what a certificate of deposit is, it's basically a savings account that you promise not to touch for a period of time. A period of time could be short, could be 6 months. A period of time could be long, could be 5 years. And in exchange for the promise not to touch it for those 6 months or whatever, the bank's going to give you a higher interest rate, more interest, than you would on a regular savings. That's basically what a certificate of deposit is. Okay, so it's a savings account you promise not to touch for a period of time. And then they promise to give you extra interest for that period of time. That's that. It's a bank product, so it's covered for under bank insurance. So there's no risk of losing your money on it. Banks, businesses need checking accounts because they have to pay their bills. All bills are paid with checking accounts. Whether it's a payroll account, which is a checking account, or just general, they're writing checks all the time to pay bills. Well, what if they need a bank for other services? Yes, they keep their cash there. They might have savings accounts, even CDs. But oftentimes businesses need loans. Banks often offer many business clients, based on their opening an account with them and their financial information that they've provided, oftentimes it'll come with a line of credit. So a line of credit is just simply a loan that's already been approved, even though you might not need it right now. Okay, and those lines of credit are handy for meeting those cash needs that we talked about earlier. You could also have a revolving credit agreement with the bank, which is a guaranteed line of credit that you can use anytime. And that's also important. But these are short-term business loans, so they're going to be paid back very quickly within the year. You borrow, you pay very, very quickly. Sometimes you need more time to pay and more money to pay, to borrow. And so oftentimes these long-term business loans tend to be pretty large, and most lenders, most banks will say, okay, we'll be happy to give you a loan to buy this new building, or we'll be happy to give you this loan to buy new equipment for your company and make it more profitable. But you have to put up the building as collateral. You have to put up that equipment as collateral. So basically, when you have a collateralized loan, which is very common, You're giving the lender the right to take the asset if you don't pay. So for example, if, excuse me, I'm a car loan, and a lot of us have car loans, you know, when you buy a car. Well, if you stop paying on the loan, you give the lender the right to repossess the car, to take the car. Because as part of a car loan, that's part of the terms of the contract. You have agreed that the car is collateral for the loan. So if you stop making payments on the loan, you automatically give the right of the lender to take the car. That's basically what a repossession is. For a house or a building, it's a foreclosure. But the process is the same. When you were able to purchase the building, you got a loan from the bank, but the bank wanted the building as collateral, right, as a promise to back up the loan. And so what you've already done in accepting the loan agreement as part of the contract is you've agreed that if you can't pay back the loan, you're giving permission for the bank to take back the building. So for personal financial stuff, that's what a foreclosure is. You basically, it's when the bank basically sues to change the owner of the house from you to the bank because they own it, because you stopped paying on your loan. So this happens more than not because long-term loans often have collateral. Businesses, and this is interesting because your book here starts off indicating how many Americans have credit cards and all this other stuff. I want to talk about it from the business perspective, right? So when a business decides to be part of the Visa or MasterCard or Discover or American Express networks, they have agreed to pay a fee in order to accept the credit card. And these fees are sometimes they're relatively small, 1 to 4 or 5%. And that means that for every $100, say the fee is 3%. And I'm a merchant, I'm a business, I sold you something for $100 and you use your credit card. Okay, well, what am I gonna get is, you're gonna get a bill because you use your credit card. What am I gonna get as the business who sold that stuff to you? Well, instead of getting $100, I'm gonna get $97 because I've agreed that 3% of every transaction is the fee that I pay to Visa for being part of the network. So I'm still getting cash at the end of the day or within a day or two. I'm still getting cash. So even though I accept credit cards, it's actually a cash sale to the business. I just have to subtract that fee that I agreed to be part of the network. So every merchant that becomes part of the network for Visa, MasterCard, et cetera, they've agreed to pay a fee, to give up a portion of the sales to the credit card companies or the network. Okay. And so, again, that fee is really part, but for businesses, it's worth the fee because a lot of people don't carry around cash anymore, but people will have their credit and debit cards with them almost all the time. And so it's in the business's best interest to basically become part of the network and accept the fact that, okay, I'm gonna pay a fee. I'm going to give up some of my sale to be part of the network, but I'm going to increase my sales because everyone has a Visa, MasterCard, or a debit card. So more people will be able to do business with me because I accept all those. Okay. Debit cards are different as to credit cards because a credit card is a loan. A credit card, you apply for a credit card with a bank or a financial institution who decides to give you a credit card with a certain line of credit. But that's a loan to you that they've basically pre-approved. So all credit card uses for the customer is a debt for the customer. They're going to get a bill. But the merchant who they bought the stuff for is getting the cash minus a fee. Debit cards work differently. A debit card is not a credit card. A debit card is linked to usually your checking account at your bank. So using a debit card is almost like writing a check. You've taken money directly out of your checking account to the merchant who you just did business with, to the business that you just did business with. So electronically subtracts the money right out of your account at the time you use the debit card. Okay, so that's important to know. Of course, again, this is talking a little bit more about banking, not necessarily about finance, but certainly, you know, there's a series, there's computer terminals that create this electronic funds transfer system that we use. So when you use, excuse me, your debit card or your credit card, all that money is being transferred electronically through the banking system. A lot of people don't like that, but it's safe. It's been the way we've been doing business for a long, long time now. And so that's just part of the system, but I'm not really going to get into it. For businesses that actually do business overseas, they might import product from another country, for example, or they might sell their products to other countries, to businesses in other countries. Well, they're going to need a bank that is an international bank to provide them with either a guarantee that the seller is going to get paid, okay, called a letter of credit, or they're actually going to cut a check to a third party on a certain day called a banker's acceptance. But basically, this is really involved when we either import, which means we're buying products or services from another country, or exporting, which means we're providing or selling a product or service to companies in other countries. Okay, so you'll need these if you're doing international business. But let's get back to our little financing issues, right? Needing cash to pay bills for the short term. Okay. Short-term financing means that it's just simply less risky, because it's very unlikely that the financial condition of the company that you've agreed to lend money to is going to change over the next couple of months, next few months. So it's easier to determine whether the loan will be good, and you can process these relatively quickly. Short-term loans are usually much smaller than the long-term loans because they have to be paid back quickly. They have to be paid back very, very quickly. And the other wonderful thing about a short-term loan is, in most cases, no collateral is necessary. You don't have to put up any assets. You can actually get it based on your reputation or your credit score, because it's short-term. So we call that unsecured financing. If it's an unsecured loan, it's not backed by an asset. It's not backed by an asset. Businesses also are able to save money by using trade credit. Oftentimes, one business will sell to another business and allow them 30 days, 60 days, 90 days to pay them. Okay, that's trade credit. That's trade credit. There are also notes that are issued. So businesses can lend other businesses money in the form of a note. Okay, that's called a promissory note. And again, it's a written pledge that the borrower is going to pay back the money on a certain day with interest. Okay, that's basically a note. Okay, again, interest is part of a note. Okay, it's a contract. So if there are some advantages to actually having a note, it's a contract and it's negotiable. So an unsecured bank loan, if you're able to get an unsecured bank loan, and if you're a very good, if you have excellent credit, you're gonna get the very, very best rate that the banks have to offer its business customers, which is what the prime rate is. You might have heard that in your economics class or in the past about the prime rate, it's basically the best interest rate that businesses get loans at from banks. Normally, the prime rate is for very large corporations that have excellent credit ratings. All other businesses that are smaller or newer are not getting prime rate loans. They're getting higher. Their loans have a higher interest rate. Okay. It's an unsecured loan, which means that there's no asset pledged as collateral in case you can't pay the loan back. It's simply based on your reputation, okay? Which is why the word credit rating is used here. You and I as people have credit reports and credit scores. Corporations have something called credit ratings. And those are done by specialized companies on Wall Street. Okay. Another thing companies can do is corporations can let other corporations borrow money. This only happens among the largest corporations. Okay. So Microsoft might be able to lend Amazon some money. Or Walmart might be able to lend Disney some money, short term. That's called commercial paper. But it's basically a short-term loan between very large corporations. These loans are short-term because they usually cannot exceed 9 months. Oftentimes they're much shorter than that. Okay, but it's a short-term loan. The prime rate is going down. It has been going down for many years. It's lower than this one is at this point. Excuse me. And so obviously, if you are a large corporation with an excellent credit rating, you can borrow money on the cheap, for sure. And if you can borrow money on the cheap, you're going to have a higher risk return ratio. You can use that money to do lots of other things. Other businesses need to buy a lot of inventory. So if you're in a retail type business or a manufacturing business, you're going to buy a whole bunch of stuff. Right? For retailers, they buy everything before they sell it to you. So you walk into your favorite store, there's already tons of stuff on the shelf. Well, they bought all that. That's their inventory. It cost them a pretty penny to buy inventory. So sometimes they need loans to buy inventory. And so that's a collateralized loan, or what we call a secured loan. Okay. Same thing with manufacturers. Manufacturers often need raw materials to create finished goods. And so they might also need loans to purchase those. Some loans can actually be secured by the company's accounts receivable. Accounts receivable, if you might remember from the accounting chapter, is the amounts that are owed to the firm by customers who have yet to pay. Okay. And so those receivables technically have value because most receivables will be collected in the form of cash. So sometimes a company might be able to get a loan and pledge their receivables. They don't have to pledge their receivables. They can actually, in many cases, sell those receivables outright. The process is called factoring. And that's when a company actually sells their accounts receivables because they need cash. They sell them to a firm that specializes in buying and collecting receivables, which is what a factor is. Okay. It's a specialized company, could be a bank or another financial institution that specializes in collection of accounts receivable. The factor buys the receivables from the corporation at a discount. They keep the difference as their profit. Okay, the corporation gets the cash they need, but they have to guarantee the receivables are collected. So your short-term financing methods that your book reviews is sort of summarized in this table, 16.2. Again, there's different ways to look at where companies get money to buy certain things. So if companies buy from each other, they can use trade credit, which is low cost, usually have to be paid within 60 days or so. They can do a promissory note, which is a loan. Okay, it's usually unsecured, but it is a legal document because it is a loan. They can get an unsecured bank loan. Again, it's a bank loan, but there's no collateral that's required. Corporations can let each other borrow money short term. Again, it has to be less than 9 months, called commercial paper. It's only the very, very largest corporations that do this. Okay. Then, of course, there are secured loans. When you have a secured loan, oftentimes the cost to the business is relatively high, or you can actually sell your receivables to a factor, in which case you are giving up a portion of the value of those receivables to have the cash now. So the cost tends to be very, very high. Okay. And those are the short-term financing methods of a corporation. When we get into stock and other types of things, that's long-term. So we're going to look at that in the next class. Okay.